Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Creekmur. On today's episode, we'll look at Wall Street's rebound from April's meltdown. Seems to be showing some signs of exhaustion, and analysts are divided on the market's near-term prospects. In a moment, we'll chat with John Creekmur. He is the CIO at Creekmur Wealth Advisors. But we begin this morning in the Asia Pacific. Joining me now is Mark Konyn. He is the Chief Investment Officer at AIA Group. Mark joining from our studios in Hong Kong. Good of you to stop by. It would appear, at least for the next 3 months, that we're in some kind of truce between the U.S. and China with respect to that trade war. I'm curious to get your take, your expectations. During this next 90 days or so, what are you expecting to see unfold?
Well, we're certainly getting some relief in the markets. I think investors have been extremely stressed and tense about the possibility of a total decoupling of the two major economies globally. This truce, as you put it, Doug, and it is a truce, allows for much mediation, much needed mediation, a resumption of communication. Despite what we were hearing, we understand that the communication had broken down significantly. So this allows a pause in, I wouldn't say hostilities, but a resumption of normal relationships, so there's communication. It also allows for certain headlines to come forward and buoy investor sentiment and set a scene for greater communication and hopefully some agreement. But remember, the backdrop is still very, very difficult. If we put it in context of Trump 1.0, where there was a trade agreement, that was never fully implemented, and we can point fingers as to why that was the case. But the expectations certainly are still quite uncertain. So although headlines look great, there's a lot of work to be done ahead of us.
So there had been this view in the market that Trump was essentially using this opportunity to negotiate new trade deals with other U.S. trading partners other than China, and that would have provided the administration an opportunity essentially to set some type of restriction for those trading partners in their dealings with Beijing. The move may be to isolate China just a bit, and I think Beijing even called it collusion. If you accept that that was the strategy that the U.S. had employed, has that failed outright?
Yeah, so that was certainly a topic, and we did see a reaction from Beijing, which addressed that directly, that it was inappropriate to use those tactics to isolate a third party, a third country. There are accusations that have further come out in the trade discussion between the US and the agreement ultimately that was signed between the US and the UK, which was to the detriment of China, and I think that has legs. It will still be a topic which will be in the public domain. So I think that theme is very much there. China now has more direct relationships and bigger trade relationships with more countries than the US does. So I was reading articles that the US had underestimated the extent to which China is fully enmeshed in the global trade system. And China's done a lot of work to clean up, if you like, immunize its own supply chains to make sure that it is robust and less dependent on the US strategically. So the balance in the negotiation is much finer, I would suggest, than perhaps the US administration had anticipated going in following these tactics of trying to bully China into yielding on the trade side.
Would it surprise you during this period of negotiation between Washington and Beijing for the China side to essentially continue to work at developing other markets, especially in Latin and South America, kind of going to the point that you're making about the need to broaden and expand into other areas of trade?
China's already doing that. As we speak today, Doug, there is a major forum in China with the states of Latin America and the Caribbean. So China has continued to use so-called soft power as well through investment and infrastructure development and extending concessions in terms of trade terms, both here in Asia very, very significantly, which puts a number of other economies sort of in the hotspot, if you like, caught between two stools between the US and China. But China will continue this. I mean, China's also on its own mission of Made in China 2025. Which was the original strategy when Xi Jinping took office, and that is still playing out as well. So China's emergence as a major trading partner globally continues to be buttressed by other forms of soft power and ways in which it's been building relationships with other trading nations.
I'm curious to get your assessment of the net impact now on the Chinese economy. I saw recently that JP Morgan lifted its forecast for China GDP this year to a rate of around 4.8 from its earlier estimate of 4.1. So in that view, let's call it a truce, is definitely going to have a positive impact on growth, at least in the near term.
Yeah, no doubt. I mean, it's a relief. It gives the authorities a little bit more maneuverability in China to take its time as it starts to look at measures to ameliorate the slowdown. So we've been talking, and we've spoken about it before, we've been talking for a long time about stimulus measures, both monetary and fiscal. And we saw more recently measures to marginally improve lending conditions and to set up funds to target particular sectors within the economy, technology, funds available to support the elderly, to focused on job creation. All of these things look good in the headlines, but when you read through the numbers, they are modest in scale, because as we know from the past, when China has stimulated with the so-called bazooka, the after effect had a very significant impact in terms of misallocation of resources, and the authorities are very reluctant to see that occur again. So it's a step-by-step. This ceasefire allows China to take a look and see how the land is settling, the landscape is settling after the initial flurry of volatility and sort of weaponizing trade.
A moment ago, you referred to the notion of decoupling, and I'm wondering whether you feel that there may be something that has been kind of irrevocably damaged in the relationship between the U.S. and China?
I think that's definitely the case. I think the path that we were on previously is no longer viable. I think it's beholden on China and other nations, really. This is not limited to China, to really reassess its relationship with the US and its dependency on the US in a number of areas in terms of not just economic but also security. So for China, I think economically, clearly, cleaning up its supply chains, making it more immune from being dependent, and really focusing on, which is something which has been around for a long time, the domestic economy, and trying to build domestic consumption to replace its dependency on low-cost manufacturers that flood global markets. And it's something that it needs to get out of. There's been a big drive towards automation. I think China has surprised significantly the pace at which it's been able to automate its industrial sector, and that allows for it to be far less dependent.
So can markets now settle down and accept this new paradigm, or are we in an elevated period of continued uncertainty that's going to create more volatility, especially in the foreign exchange?
Well, certainly the pressure valve has been foreign exchange. As we've seen dislocation, we've seen currencies in this region, most notably the NT dollar, Taiwanese dollar, has had a major revaluation in a very short period of time, and the degree of proxy hedging, because it's not easy to hedge longer term on the NT dollar, has caused other currencies to rise in tandem. So there are a number of examples of how that dislocation plays out in the FX markets. But more fundamentally, yes, I think we are seeing a resetting. We are seeing volatility ease in stock markets. We saw the VIX peak at just over 50 for an extended period, which is very unusual, but it's now back down below 20, and I think investors have taken a big sigh of relief as we've seen this truce in the trade negotiations between the US and China. But I don't think that investors are really seeing this as a return to the previous pathway. I think certainly what we're doing is we're taking the opportunity to continue to diversify out of US equities and move money more internationally to get more of a balance in our exposure, which makes a lot of sense given the ride that we've had and the sensitivities that we've had to certain sectors. I think the headlines will still steer markets. We've seen now, as Trump has moved through the Gulf states, the Middle East, that's had a very significant impact on certain sectors as big announcements have been made. Whether or not there's follow-through and there's commitment to really deliver on those announcements, in the past they've typically disappointed. But the headlines do move markets. So the volatility subdued somewhat, but continues to be an issue that we're watchful of, and making sure that we're not caught out in the short term as we try and create a more balanced position so that any one factor would not distort valuations.
Mark, I'm curious as to whether there is a particular strategy with which you have a high level of conviction that may be a little contrary right now, that you think will be effective over the next 6, 9, even 12 months from now.
Yeah, so we don't think yet US inflation has peaked. We saw the April print, which suggested that the impact of tariffs was not as heavy as anticipated. I think it's too early to call that. It's definitely the case that we don't see the supply side constraints in the US. The backlog that we saw at the ports in 21 to 23 is not there. The demand-supply situation in the labour market is in favour of supply rather than demand, so that is another inflationary factor which is taken off the table. And of course, lower energy prices is going to flow through. So we don't see the build-up of inflationary pressure, but we still haven't reached the peak, which will probably sort of come out at about 4% and then ease as we get towards the year end at around 3%. With that in mind, our view on the US economy is for below trend growth at about 1.3% as we get through to the year end, a sort of J-curve type shape for 2025. In context of that, earnings are holding up well. We think credit is probably still, the spreads are still too tight. But given those views on inflation, we see an opportunity at the long end of the curve to tactically overweight duration exposure to rates and wait for the curve to adjust and come back down.
Mark, we'll leave it there. Thank you so much for visiting with us. Mark Konyn there. He is the Chief Investment Officer at AIA Group, joining from Hong Kong here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Creekmur. So today, the equity market did show some signs of fatigue after an epic rebound over the last month. Since those intraday lows in April, the S&P is up a whopping 22%. Interestingly, today, the CNN Business Fear Greed Index approached extreme greed, and we had the S&P rising just 0.1% today. Joining me now is John Creekmur. He is the Chief Investment Officer at Creekmur Wealth Advisors. John's on the line from Morton, Illinois. John, thank you so much for making time to chat with us. How would you characterize where we are right now in this cycle in the equity market?
I'll tell you, we're at a very interesting time, to say the least. And, we came off last year where the Cape-Shiller hit the second highest recorded level as far as in the history of the market. The highest one is actually in December of 1999. The market was overvalued. It was looking for a reason to sell. And quite honestly, the first 100 days of the Trump administration pace was fast and furious. And when we had Liberation Day, the so-called Day of Liberation on April the 2nd, that was the event that created immense uncertainty. And we actually hit a 20% decrease. And as you had just mentioned, we had bounced off of that. We made back a large portion from the sell-off from the high on February 18th. Now we are at a point in time where all of a sudden the bounce back has happened. There seems to be a bit of uncertainty. However, we believe that the buys have gotten ahead of the sells, and we're really looking to see, are we going to stay above this resistance level, which was 58.33, and close above it? If so, we have room to go higher. However, we're still navigating the uncertainty of what the actual effect of these tariffs are going to be overall in the economy.
So when you look at certain areas of the market these days, where are you putting your focus? Where is the opportunity?
Right now, we are really looking for companies that have a strong, wide moat, and so they have a competitive advantage. We do see some opportunities as far as oil and gas exploration, but really as far as the pipelines, we love Enbridge here. And again, strong moat, the demand for their product is going to be there. We're also looking for opportunities in select technology areas. We do still like companies such as Snowflake. We just initiated a new position in Snowflake as far as in the company. And so there's tremendous opportunities. But again, value is the key right now. And when there's uncertainty, value is the key.
So these days, if you look at the swaps market, pricing for Fed rate cuts right now, only about 50 basis points between now and the end of the year, and perhaps we don't get the first rate cut until September. Where do you see the Fed in your thinking and the extent to which rate cuts will push the market higher, if at all?
So with rate cuts, we really have to look to say what is going to be driving that. The Fed has really been focused as far as on inflation as the number one metric they're looking at. We had a really nice surprise as far as on inflation numbers that came out earlier this week. And we'll have to wait and see how numbers later on this week play into it. However, even with the most numbers that we've seen here recently, really it's about seeing how do things play out throughout the rest of the summer. We do forecast at least a 0.25% decrease as far as in rates sometime toward the end of the third quarter in the September meeting, and potentially another decrease there early on in the fourth quarter, possibly in October or November. However, a 50 basis point decrease is probably the most we're going to see this year. We do believe the market is already starting to price in at least a 25, if not 50 basis point decrease later on this year. So some of the most recent run-up actually is not just from some of the issues being resolved as far as in the tariff arguments and tariff wars that we're seeing, but also a little bit of advanced thinking that we are going to see a decrease in rate cuts. So the market is getting a little bit ahead of itself in anticipation of the rate cuts that could provide a little bit more instability if the economic numbers do not play out for the rest of the summer.
We've talked a little bit about the market overall. You were talking about some of the technical indicators. We've brought the Fed into the story. And I'm curious as to whether or not you're seeing opportunities offshore right now, if at all.
Yeah, we are. And so we were actually early investors early on in the cycle in the end of January as far as reallocating dollars over into Europe. Specifically, we really liked Germany at that period of time. We made some early plays as far as in the early part of February, as far as in defense contractors, specifically in Germany. We believe with the current administration to be a larger level of demand that different countries will prepare for their own defense. And so because of that, we know that countries are finding dollars to allocate toward defense spending, and they're favoring companies within their own country. That run has actually started to slow down. We do look for countries that are not going to be greatly impacted as far as with the current trade dispute that we are in. And so even if we look internationally, we like developed countries. We're looking for companies, again, that have a strong balance sheet. And the third leg as far as in decision making is for companies that are more domestic as far as in their overall sales, or if not domestic, their trading partners are more friendly as far as to the current environment.
John, before I let you go, I'm wondering whether or not there is a conviction trade that you have right now that may be a little counterintuitive.
Yeah, there is. So, we really believe that the huge sell-off we saw as far as in the large name technology sector was tremendously overblown. And so whenever we see drastic reactions and drastic movements as far as with any individual name, any sector, any country-specific index, typically those are large emotional moves in which the people are viewing a possible consequence in the most extreme manner. And so we believe there are some phenomenal names. Now, they were extremely attractively priced 3 and 4 weeks ago, and yet they are still competitively priced at current levels. And so we're looking not just at the Mag 7, but we're looking at industries really as far as in either artificial intelligence and advanced computing in the storage space that became oversold relative to whatever their competitive advantage is. We were actually adding into some big names 3 weeks ago at some phenomenal prices, specifically the semiconductor space. Supermicro had a phenomenal day with strong earnings. We're seeing earnings still intact. We're starting to see trade agreements actually benefiting some of these larger names. We still love some of the old homegrown names that we're seeing tremendous value, such as Microsoft, which has been really beaten up. Tremendous value in those type of companies.
John, we'll leave it there. Thank you so much for joining us. John Creekmur there. He is the Chief Investment Officer at Creekmur Wealth Advisors, joining from Morton, Illinois, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Creekmur, and this is Bloomberg.